Okay, everyone. So my title is quite controversial, why audit statements are untrue and unfair. And so let me make my case about that. But I want to take you all to the medical profession first, 150 years ago. And the medical profession in the 19th century essentially was where doctors were giving things like heroin, brain salt, leeches, and so on for medicine. Now, the doctors of that time, as you can see from the 1 minute point options, laser pointer, let me get that. From these doctors over here, you can see that these doctors come today and try to practice medicine. They will have a completely different idea of the medical profession. As you can see today, the doctors of 150 years ago will not be able to do anything in medicine today. Let us look at engineering. Engineering in the 19th century, very good mechanical engineering did all sorts of great things. But even those engineers today, especially when they come to the era of robotics and so on, will not be able to perform in today's environment. But now let's look at our own profession, accounting, especially financial accounting. Financial accounting essentially was where we had in the 150 years ago, what we had was what is called a T account. You had the assets on one side, the liabilities on the other, and the owner's equity. And we had total assets equals total liabilities and owner's equity. So that is now what we can see 150 years later today. We have done a lot of innovation, just like the medical profession and the engineering profession. We have really innovated. Okay, and today our balance sheet is quite different. It has assets on top, liabilities and equity below. So essentially, that is our innovation that we've had for 150 years. A 150-year-old accountant can come and look at our balance sheet and understand it perfectly. Rather than putting side by side, they go downwards. Now, this, I believe, is a great shame that we have not really done anything new for 150 years. So let's look at what the situation is, okay, and why this has happened. First, we look at the concept of an audit. The audit is a trust mechanism. Okay, as you can see in this thing, it says, in God we trust, in all others we audit. So the external audit is supposed to be a trust mechanism installed to persuade the public that capitalist corporations and management are not corrupt, and companies and directors are made accountable. In other words, the whole concept of responsibility, accountability was there in the audit mechanism. So accountants, when they had the role as auditors, have cemented their status and privilege on the basis of claims that they have special expertise, very, very important expertise that enables them to mediate uncertainty and construct independent, objective, true and fair accounts of corporate affairs. So that's what accountants and auditors claim that they have. They have the expertise to do this. This expertise is claimed enables markets, investors, employees, citizens, and even the government, the state, to limit and manage its risk. That's what the claim is, that we can tell you how things can be done and audited and give an independent, true and fair view. Now, it must be remembered that audit is also big business, very big business. Okay, take for example, Australia. We had last year something called the Banking Royal Commission. And the Banking Royal Commission was incredible in what it found the Australian banks had been doing. Okay, huge amounts of moral shortcomings were exposed in the Banking Royal Commission. People who were dead were charged interest, all sorts of, they were trying to sell insurance and all sorts of things, in other words, churning. And all the banks, in fact, some CEOs lost their job, okay, because of the Banking Royal Commission. But remember that all of these banks were audited by the Big Four, especially. They've audited, and these financial institutions appeared to have escaped scot-free despite collecting large fees from them. And the fees are not small, as you can well understand, very large fees. Auditors collect large amounts in audit and non-audit fees as well. In the past decade, that's in the last 10 years, the big four auditing firms have earned $1 billion from the four banks, just from the four banks, in auditing and non-auditing fees. For example, in the period 2008 to 2018, Ernst & Young earned 286 million from the National Australia Bank, KPMG earned 203 million from ANZ, and PricewaterhouseCoopers 330 million from Commonwealth Bank, and 248.5 from the last one, Westpac. Okay, so these are big numbers. So audit is definitely big business, and it's in the interest of the auditors and maybe the accountants as well, that we need to make sure that people don't lose trust in what we are doing. So where is the conflict coming in? There was a recent scandal after the Banking Royal Commission, a further scandal, okay, that has now had a parliamentary inquiry into it, where the National Australia Bank, one of the Australia big four banks, has triggered a unanimous bipartisan support, in other words, of both sides of parliament, all sides of parliament, okay, into potential conflict of big audit firms. I mean, there was clear indication that they were essentially doing what the client wanted rather than what the shareholders wanted. Client in terms of management. The current National Australia Bank scandal erupted when documents leaked by a whistleblower shone an embarrassing light on the private workings of the bank and the cozy relationship it had with its auditor of 13 years, Ernst & Young. Now, I'm just not creating this. These are all in the newspapers. So anyone can see what this scandal was all about. Okay, so can we hold auditors accountable if we get some big problem with our companies? Can we hold the auditors accountable for what they are telling us? The need to hold auditors accountable have been highlighted in many countries. Australian parliamentary inquiry is just one of many over the years that have happened. But after a few weeks of media exposure, largely ignored. And I can bet you that that's exactly what's going to happen with the Australian Parliamentary Commission. The people are too strong, okay, in terms of their lobbying power for these to get anywhere beyond just an inquiry. The Banking Royal Commission was one of the few success stories in Australia. Here's what the International Forum for Independent Audit Regulators, an organization representing audit regulators, by the government regulators of 49 jurisdictions, including Australia, France, Germany, Italy, Japan, Spain, UK, and US. This is what they said. In 2015, they said there are persistent deficiencies in critical audit areas related to audit work on controls within companies designed to prevent abusers, valuation of assets and liabilities, and disclosure of crucial information to the public. So these are, they're saying there's persistent deficiencies. But of particular interest to Australia is that the report is concerned that auditors of financial institutions, the very ones that the Banking Royal Commission was looking at, pay inadequate attention to the likelihood of losses in the valuation of investment and securities. So there was a comment made that in the financial services sector, it seems an independent report is whatever the client's money can buy. Now that is terrible if that is the view that is coming out, that whatever the client can buy, that is the audit report, supposed to be independent. Okay, so all this criticism, what is the standard response of the financial accounting profession? What is the standard response? Enron's collapse, Tyco, Lehman Brothers, WorldCom, all of these, what are their response? The standard response to any criticism from the auditing industry is to deny the problem. They say there's no problem, doesn't appear there, or issue new auditing standards, audit reports, code of ethics, etc. So these things promise tougher action against laggards, the people who don't follow, but none of these solutions are adequate, and they're all based on tweaking of accounting standards. So essentially, they come out with accounting standards, new accounting standards. Okay, they said that will solve the problem. Okay, but the problem is not the auditors or the companies. The accounting standards itself is the original sin. Okay, so auditors are following accounting standards, but the accounting standards are where the problem is. In Christianity, the Adam and Eve ate the apple, or in Islam as well. But in Christianity, they created this original sin. And in this case, the original sin is the IFRS. Okay. So who controls these accounting standards? So as I told you, the audit is based on the accounting standards. The accounting standards itself, who creates them? If the tweaking of accounting standards is a solution, who controls the body responsible for issuing these standards in the first place? There are bodies, that is the International Financial Reporting Standards, are issued by the IFRS Foundation and the International Accounting Standards Board, IASB, which is in England. Now that sounds fantastic. There's a board, there's a government-sponsored board, and all of these, fantastic. Okay, but who is the one who are the individuals in those foundations and standards boards? An overwhelming majority of CEOs and non-accounting regulators do not know that the big accounting firms have complete control over the deliberations at the IFRS Foundation and the ISAB. So the ones who are actually issuing the standards are the auditors themselves, especially the big accounting firms. They stack the board and thus effectively control the development, production, and modification of accounting and auditing standards. Every single one, I can't say every single one because I haven't looked at every single one, but I would say easily 95% of those on the board have some big four connection at some stage of their lives. Okay. One has to only look at who sits on the standards and oversight boards in Australia and internationally. So in individual country boards and the international boards. Just look at who sits on those boards and what their backgrounds are. So there's no accountability to the public. Okay. As a result, although there are numerous international auditing standards, exposure drafts, codes, and related pronouncements, believe me, there are over 5,000 pages that they issue. Impossible sometimes to read all the pages. And certainly I don't read all the pages. I know that there are some academics who talk to me who have actually read all these pages. They are curiously silent on auditor accountability to the public. So they've talked about this standard and that standard, everything, but not are the auditors accountable to the public. That is not in those 5,000 pages. Accounting, auditing, and ethical standards are little more than risk management boundaries written for the firms and major corporates by their friendlies to keep them away from potential litigation. So essentially they are written in such a way that no one can sue them. Successive governments have been complicit in supporting this charade, as have the regulators. Okay. They have accepted this. It's in a sense one big game played at the public's expense. Surely the public should have some rights to audit quality, but they have no rights to assess audit quality at the moment. No rights at all. Although the public bears the cost of audits and audit failures, it has no rights to see audit files or to make an assessment of the quality of the audit work. It is only when a whistleblower leaks documents, such as what happened in the National Australia Bank NAB scandal, are we privy to what goes on behind the scenes. And definitely it's not pretty, as you can see from public information that's available. Auditors escape liability because under most jurisdictions, under most countries, they do not owe a duty and care to any individual shareholder, not to any creditor, not to any employee, not to any superannuation, which is pension scheme member, or any other affected by their negligence. There's no duty and care that they have to any of these people, okay, as the current legislation. So an individual shareholder cannot sue an auditor for giving a bad audit report. In many Western economies, the too big to close syndrome has continued to prevent effective regulatory retribution. These guys are just too big. However, interesting case in India. In India, under Section 140 of its Companies Act, PricewaterhouseCoopers was banned in early 2018 from auditing listed companies in India for 2 years after being accused of negligence in the audit work at the now defunct Satyam Computer Services. In fact, that was extended as well. Indian regulators are now pushing for a 5-year ban on Deloitte and KPMG over allegations that the firm helped to conceal bad loans at the infrastructure leasing and financial services, a major infrastructure and finance group whose default last year triggered a credit crisis. So India regulators are hitting back, but that's the only country I can see that there is some push to get at these auditors to be accountable to the public. At least the regulators there are doing something. And they are going after the big firms. Okay, so what if the audit firm, what does it actually tell us about the company? When you read the audit report, what does it tell us? The audit report of financial statements uses the term true and fair to express the condition that financial statements are truly prepared and fairly presented. But note the thing that I'm writing there, in accordance with prescribed accounting standards. So they're only true and fair based on accounting standards. They don't say they're true and fair in real life, just based on accounting standards. An unqualified audit opinion of the financial statements says that the audited financial statements are true and fair in all material aspects. That is, after the auditors performed the audit, they found no material misstatements in the financial statements and they were correctly prepared, but correctly prepared based on accounting standards. Now, let's see what the audit report does not tell us. It does not attest to the value of the company as stated financial statements. So what they have is book value, and I'll tell you how they calculate the book value later. They say that this book value is true and fair, but not the market value. They don't give any opinion on the market value. They do not attest that the financial transaction recorded rose out of ethical practices. They don't go anywhere near that. They would have made profit through various things like polluting the environment, poisoning the rivers, doing money laundering, whatever. The audit does not care how that revenue came. They don't look at the ethics of it. Does not attest that there has been no fraud. They say, no, we don't attest to that at all. Okay, we try to test for it, but we don't attest to it. We only say it's according to accounting standards. They only attest that the financial reports are prepared and presented in accordance with the prescribed accounting standards. That's all they're saying. It does not tell us anything else. As I told you, who develops these issues, these standards? The auditors themselves. Okay, so let me take something from my own university as an analogy. It's like the Big Four are setting the subject syllabus, preparing the exam paper, writing the answers to that exam, and finally giving a grade. And if there's a complaint, they are the adjudicators of the quality of their own work. So it's completely in-house. Okay, just imagine sitting your own exam and facing criticism that you can then comment on. That is essentially what an audit report is. Now, how has this come about? There are two primary accounting frameworks that are involved in this area. Today's financial reports are prepared based on two primary accounting frameworks: the generally accepted accounting principles, or GAAP, which has been there for a long, long time, since the start of auditing and accounting, and the newer international financial reporting standards. Believe me, both are there. And the latest report is that America is not accepting IFRS anymore, but only GAAP. So it is expecting all the other countries, Sri Lanka, Indonesia, Philippines, you name it, to follow IFRS, but not themselves. They are only going by GAAP. The audit report is flawed because the above accounting frameworks are also flawed. However, very little meaningful attempts have been made to make the financial reports more relevant for today's knowledge economy. Today's economy are completely different from the economy that we had 150 years ago. But the knowledge economy is not recognized in auditing reports and accounting standards. So why are financial reports irrelevant? Financial reports have not significantly changed in their presentation format since the dawn of the industrial era or the age of the corporation. So when corporations formed, when we needed shareholders to fund big ventures without taking risks, when we had limited liability, that was the start of accounting, the modern day accounting. Okay, when I say modern, in 1850. And also, that was the time that there were very, very large machines. As you saw from my picture of the engineering 150 years ago, very large machines. These were the assets. So land, building, machinery, these were the big assets. Okay, here are the types of machines that were the assets of 150 years ago. But in this time, tangible assets such as land and machinery were the engines of growth. As a result, the balance sheet still shows that it's mainly these tangible, non-current assets that drive business value. Okay. Your land and buildings, machinery, and so on. However, today we have totally different businesses. And it's even more, as you can see today with our current COVID-19 crisis, which I'll get to a little later. Today's big businesses are knowledge economy companies with significant intangible assets. So we have Google, which has an intangible asset of an algorithm, Apple, okay, which has essentially the entire product range based on brand valuations, Facebook, social media, Microsoft, Uber, Airbnb, and so on. These are all intangible assets, all essentially going around the computer. Okay. Huge amount of intangible assets. These are not recognized in current IFRS. So they will want you to look at revenue recognition and put out meaningless standards, in my mind, or recognizing absolutely minute levels of revenue, but they have no idea of how to value intangible assets. Okay, so you have, I mean, this is post-COVID-19, post-corona, sorry, pre-corona, I should say. Bitcoin, the world's biggest bank, Uber, the largest taxi company, Facebook, the world's most popular media outlet, Alibaba, the world's most valuable retailer, and Airbnb, the largest hotel provider. Airbnb has no real estate, okay. Alibaba has no inventory, okay, and so on and so forth. Uber has no taxis. So what's happened to the assets of these companies? They are not in the traditional sense assets. So accounting reports have not evolved. We have still are on the T account format, which is slightly evolved to a statement format, but nothing more than that. Okay. So this has caused a delusionary view of accounting reports. We give them far more credit than they deserve. What is a delusion? A delusion is a false belief strongly held in spite of invalidating evidence. We are getting evidence from all over the world constantly that accounting numbers are not right. But we still hold to this belief that they are of some value to us. Okay, it's like this little cat looking at this mirror and thinking they are a lion. Okay, they are not a lion, they're still a cat. It's a delusion. There are three major reasons why the application of IFRS results in flawed financial statements, and consequently why they result in meaningless and fictitious audit reports. First of all, IFRS estimates the value of all assets on the company's books are values if they are sold on a piecemeal basis. So what they do is they look at all the company's assets, their interpretation assets, and sees what are their value if you sell them one by one. That's what they essentially assume. IFRS is silent on intangible assets, how they can be shown on the financial statement. So only the company's tangible assets. Okay. Ignoring intangible assets has resulted in widely divergent shareholder values. So actual equity value or market value is very, very different from what the audit is telling is their book value. These equity values of what the stock market says the company is worth, which is market value, is widely different to what the audited financial statements say is the company's book value. Let me give you some examples. Okay, so before we, let me give you some examples. I might come to this later, but the examples are, say, Microsoft. Microsoft has a book value that is 95% wrong to its market value. Okay. But still, the auditors of Microsoft will say those statements are true and fair. So let's see how we add assets on a piecemeal basis. Some assets in the balance sheet can be at cost. So remember, we are adding all these assets. Some can be at cost. Other assets in the balance sheet can be at fair value. And fair value itself has three definitions. Level 1 fair value is the best because these are based on quoted prices in an active market for identical assets or liabilities at the measurement date. So that they say is the best to get quoted prices. But if you can't get quoted prices, then you can get fair values that are observable either directly or indirectly. But if you can't get even that, then you can get unobservable asset values, essentially estimates, right? And you can plug that into the valuation. So these where you get consultants coming in, okay, so-called valuers and valuing some of these assets, okay? So it's like, you know, you go to the bank to get a loan for your house, and the bank says we give you 80% of the value of the house for your loan, and then you tell the bank, look, I'll get my own valuation, and please give me 80% of that value. The bank will say, please go away, we will send our own valuer. That's not what happens in fair value. Fair value, the company hires its own valuer to value its own assets. Individual assets or liabilities are valued using one of these valuation approaches, and then they arrive to arrive at the entity's book value. The end result is a mathematically meaningless figure. Remember, you're adding cost, you're adding fair value level 1, fair value level 2, fair value level 3. So it's meaningless, like adding apples, oranges, and grapes. Okay, so let's see in graphical form what IFR is telling us to do. It tells to take some grapes at cost and then add it to some kiwi fruit at quoted prices. And then it says to take some strawberries and add it at observable values. And then to take some bananas and add it at estimated values. And then they put it all together. And that is called IFRS, essentially International Fruit Salad. That is essentially, and this fruit salad is called book value. Okay, so that's essentially what we get. And then auditors go and audit this and tell us that this is the fair value according to accounting standards, but the accounting standards themselves are based on this fruit salad. Okay, so what happened in the global financial crisis? Let's go back in history a little bit, see what happened and see how it relates to today's COVID-19 crisis. In the global financial crisis, as you know, lots and lots of subprime mortgages were there that were virtually valueless. Much blame was placed on the vagueness of accounting rules, particularly fair value accounting or mark-to-market, counting accounting and subprime mortgages and financial assets. At the start of the GFC, there was no market for worthless mortgage-backed securities based on subprime mortgages who had by then defaulted. So if the subprimes are worthless, most often the company itself was worthless. and many of them crashed, like Lehman Brothers and Bear Stearns. But what happened? George Bush with Henry Paulson, the Treasury Secretary, the former person of Goldman Sachs, they gave 700 billion bailout money. So suddenly they gave the bailout money to the that had worthless assets. So suddenly what happened? So even though there were companies that were insolvent, okay, when they gave the rescue plan, they had some value. So just think about this. If you had worthless subprimes, then you could get money from the US government. And now that very money that you were getting as a bailout was considered an asset. Okay. The SEC and FASB in USA were prompted to issue a clarification on fair valuations of toxic assets. And they said when an active market for security does not exist, management estimates that incorporate expectation of future cash flows, not, and that is the potential of the bailout money can be used. So suddenly these companies had a value, which is the bailout money, which is ridiculous. In fact, there was even a push to abandon fair value rule by the financial sector in the USA. Okay, so that was what happened. So the bailout money itself became an asset. So let's look at the COVID-19 world, the world we are in today. What will happen post-COVID-19? We know that there has been massive government bailouts, far more than the GFC bailouts for USA. In USA, they pumped 1.7 trillion to keep companies afloat. Just to give you an idea of the scale, from the time they floated the dollar to August last year, the US debt, net debt was 3 trillion. Then in August, they suddenly started printing money. Essentially, net debt is printing money, okay? They don't physically print money. They actually give some things to the banks to make use of, right? So it went from 3 trillion to about 4 trillion. But when the this COVID-19 bailout happened, they were already into 4 trillion, they went to 6 trillion. So in the space of less than 1 year, the US has doubled its net debt, doubled it. And it's all printing US dollars. And we all taking these US dollars, okay? Now, normally in a situation like that, when the US dollar is printed like that, the value of the US dollar should fall. But here the US dollar is not falling because all the other countries are using that as the currency, okay, for their own transactions. Okay, so US dollar is actually keeping its value despite doubling its amount of money out there. Australia has now a 700 billion JobKeeper payout, 700 billion, okay, and taking money from future generations by printing it, okay. Okay, without these, companies will go into liquidation. So a lot of companies are being kept afloat by this JobKeeper money. Already I'm getting calls from all our people that the money has suddenly started coming into their accounts, okay. But let's take one example of a valuation now. We have an airline called Virgin Australia, which has gone into receiverships. No one is flying. They had massive debts. They couldn't pay up. No one is going to bail them out. The governments in Australia said that we are not going to bail you out. Richard Branson said, if you bail us out, I can give my island in the Caribbean as a surety. All these things are there. But Virgin Airlines have gone into receivership. So what is the asset value under fair value? Should it be cost? When the aircrafts are purchased, less depreciation. But should it be market value for the assets itself? That's the aircraft. No one is buying aircrafts these days. Even Boeing can't get rid of all its MAX aircrafts. So it has to be either market value, where you get bidders and there are lots of people interested to come and give a value, but this value would be nothing to do with the fair value in the audited statements, nothing to do with that fair value. Okay? So that is the situation. where it is possible. I mean, we don't even know how to account for this JobKeeper money. Is it revenue? Is it accrued expense? Accrued revenue? What is this? We have no idea. Okay, it's going to be very interesting that the bailout money could be used as a fair value. Okay, so the big problem is that the intangible assets are not being recognized. An intangible asset is an asset that is not physical in nature, such as goodwill, brand recognition, intellectual property, and so on. Okay, intangible assets are only recognized by IFRS if there are an arm's length transaction that brings the value into a particular date. So if Google was to buy Microsoft, then there would be a third-party transaction, and suddenly all of Microsoft's intangible assets will suddenly become assets as goodwill. But why should there be a third-party transaction? The market does not wait for third-party transactions to occur. Further, whilst there are many difficulties in estimating fair value of intangible assets, it's almost impossible to do so with most intangible assets, as they cannot be sold on a piecemeal basis. The whole value of even Virgin Australia, Microsoft, is to sell it as a whole, not piecemeal, as what the accounting standards do. So here are some examples. As I told you, I have some examples of divergent values. Microsoft, June 29, market value is 82.72 billion, right? Sorry, book value was 82, market value was 768 billion, 9 times book value. Okay, Walmart, book value 77, market value 320, 4 times. Okay, the auditors of both companies stated that the book valuations are true and fair, then they have got it wrong in terms of market value by almost 900% and 400% respectively. Now in Australia, we had I'm going to go quickly now because I want to give some questions. We had a flammable cladding crisis where buildings caught fire because of bad cladding in their apartments. Okay, so I'm going to go through this fast. Okay, what happened was that the building guys got together. They made sure that these things are okay. They had a good public opinion on this. Okay, and essentially they tried to fix it. In Australia's flammable cladding crisis, a national approach to fixing the problems has been called for, which includes applying strict standards of practice to new builds, best practice regulation, protects the consumer, and government financial support for affected property owners. In the case of the audit crisis, government should ensure the best practice regulation protects companies by not allowing self-regulation, issuing auditing standards, exposure drafts. They shouldn't be self-regulated, not allowing audit accountability to be ignored in the legislation, and not allowing book valuations to be unrelated to market valuation. That is a very important thing that should happen in the future. So how to fix a problem? The one simple fix is to have 3 different balance sheet values. 3 different. One, saying these assets at cost value, these assets at fair value, level 1, fair value level 2, fair value level 3. Another simple fix is to use the intangible asset problem, is to bring into the books the difference between the book value and the market value as unrealized intangible asset value. So take the book value, take the market value, the difference, and on balance sheet date to be brought into the balance sheet as unrealized intangible asset values. These are simple fixes, at least as a start, but not done by IFRS. One criticism of the simple fix is that it's common to see even large cap stocks moving 3 to 5% up and down during a day's session. True, it can move 3 to 5%, but not 900% and 400%. That's the important thing. Okay. So that's the thing that you can do balance sheet value at market value and book value and bring it to the books. So we really need to rethink the accounting model. It's not the interest of the accounting and auditing profession to perpetuate the delusion of a true and fair view. The financial accounting and auditing professions need to rethink the accounting model to fit the new information requirements of a knowledge economy. Of specific interest in rethinking the reports would be the separate reporting of assets and liabilities, measured under different valuation hierarchies, the recognition and measurement of intangible assets, and closing the gap between market values and book values. Only then can a proper audit be conducted. Okay, so is it time for a mandatory strategic audit? These are linked to management accounting. Should we be auditing the future, which is a strategic audit, rather than auditing the past, which is a financial audit? Okay, so there are many areas that we can audit a future of the company. It's not mandatory. You should make it mandatory. Okay, what is needed is a statutory audit of expected future performance and how it affects the current value, not an audit of past performance and fair value of individual assets. So really more of a risk management area. Such audits are called strategic audits. Since there's evidence that businesses are behaving badly in illegal but not often unethical pursuit of higher profits and shareholder value, the key is for the government to legislate that companies undertake compulsory strategic audits to evaluate business practices beyond simply the financial reporting of the past. Now, I think that many companies will have to do this anyway after post-COVID-19 to see where the companies are heading. Okay, now let me quickly finish by taking you back to the Titanic. I think all of you know what the Titanic is. The Titanic is, of course, where there were people on board, and the financial accountants would stand at the back of the Titanic, okay, and report on the waterway, what happened in the past. Okay, when people ask me about what's the difference between management accounting and financial accounting, I say, think about the Titanic. Financial accountant will stay at the back and see how the water is going. And the management accountant will stay in the front, okay? As I said, there were 14 financial accounting, keeps books on historical transactions in the Titanic itself. Now the management accountant will stay on the front and look after, see for icebergs, a future audit. But unfortunately, there were no management accountants on the Titanic. Okay, they had actually only 2 humans in this crow's nest over here looking for icebergs, but even then they had no binoculars, so no proper computers or anything like that, any things that help them to do their work. They just stood up here and didn't even have binoculars. So we really need people up here. Now, the Titanic sank because there were no management accountants. Okay, no management accountants. Okay, with that, I will stop and raise it for questions. Thank you.
Thank you, Janak. Really exciting presentation on the audit profession in per se. Now, we have opened the session for some questions if somebody wants to ask any clarifications or make any comment on the presentation. Janak, whilst we're doing that, I had one question come up to me, which was one of the participants said that, do you think that it's about time that with all these issues happening and with the issues with our IFRS especially, it's about time that we go back to the olden days where each country had their own standards depending on their own country specification issues?
Well, certainly IFRS force-fit international standards on countries, often where the standard had no bearing on their own economies. Okay, so we had essentially England and USA force-fitting standards on countries that essentially didn't work like they did, especially countries like Indonesia and Sri Lanka and so on. Okay, but they were forced to take IFRS because there were vested interests among the accounting people, but as well as the fact that you couldn't get any World Bank money and so on. So yes, a first step could be to go back, but my point is that even if we go back, we really have to rethink our entire model and bringing intangible assets. Okay, now if some countries have companies that are more to the old style of business, that's fine. But if they don't, but today intangible assets are in or knowledge economy companies around the world, right? So I think they really have to rethink the model and not make it international. You're right. In that way, you're right. Okay, make it national, but also take into account the environment of the country. Don't force feed or don't colonize with accounting standards a country. Okay.
Right.
That's my answer. Yes.
Thank you, Janak. Janak, if you open up the question answer tab, we've got a
Yes.
question from Chatura.
Right.
It's a bit of a long one, so I think based on Sri Lanka,
Yes.
you can read that across.
Okay, let me read the question. International agencies, Moody, Finch, etc., are downgrading Sri Lankan banks continually and now look towards outlook is more negative. Do you think the downgrade will help economies like Sri Lanka? Will that add value to society, destroy the value, etc.? Okay, so he's asking if the Moody's downgrading is going to affect. This is more an economic question rather than a question, but I'll answer it. You see, these very companies like Moody's and so on, they were the ones that gave valuations to all the subprime mortgages, right? And they said they were AAA rated, right? And these same people, when they were questioned why they were giving opinions about subprimes when we knew they were of no value, they said that's only our opinion. So they got away by saying that's our opinion. So essentially, that's what's happening. These people are downgrading, and it can definitely affect countries' economies, right? But they will get back and say, no, we are not. That's our opinion. So that's my view on that.
Thanks, Janak. There's another one from Noel under the chat window. Noel asks saying, under what standards where future performance audits will be done? Is there a future audit engagements going on now?
Yeah, okay. That's a good question. There's at the moment no accounting standards to per se in future performance audits. But it's not called future performance audit. The strategic audit itself has a number of components. For example, there are standard ways of doing a stakeholder audit. Okay, and we actually cover that in our CMA class. There are standard ways of doing a marketing audit, a leadership audit. There's no standards, but there are recommended guidelines of how to do this. So there are about at least 30 guidelines for how to do these future strategic audits, including information security audits, technology audits. Leadership is a big one, okay, especially in countries like Indonesia and Sri Lanka, where many companies have a person who started the company, but all the children have gone overseas and there's no one to take the company over. So there are a number of these future performance, okay, guidelines, I should say, which comes under strategic audit.
Thanks, Janak. Janak, there's another one in the question answer window. We've got three questions there. Would you answer one of them in line?
Okay. How come audit companies are so powerful when it comes to taking action against presenting wrong statements? They're powerful than the governments. Okay. So, yes, the shareholders cannot sue audit companies for giving a bad report. That's because they say that this is what we do. We are essentially giving an opinion based on the accounting standards. Okay, so shareholders can't. And of course, these auditors are very, very powerful in every country. Only India seems to have managed to avoid it. They're very powerful. They are lobby groups. They are very powerful. They are professional bodies in financial accounting world are very powerful. So at the moment, it seems to be that only India seems to be winning the battle, but others are not. Okay. Next question is, why is UK moving towards IFRS or in its own standard? These are jumping around a little bit. Okay, so what's happened? The IFRS standards board is in the UK. There's a lot of vested interest there for them to continue with IFRS, but they have not managed to get the Americans on board. Okay, so Americans are going their own way with GAAP, and Britain is going their own way with IFRS. So that's essentially, I mean, remember that an IFRS compliant auditor can charge far more money than a general auditor. So there is also some big business issues there as well. Okay, now next question is from Boy Washington. If a company received a bailout, you think government can drive whatever to do with the money? At the moment, it appears they are asking companies to spend more money to boost the economy. Governments are not actually telling companies what to do with the money, except to essentially, that's the way I read it, essentially to give it to their employees, to give it and boost the company and not go under. So that's, they're giving essentially, without any strings attached, this bailout money. Okay, they can't, as far as I know, they can't direct a company to what to do with the money. So that is 2 questions there. Next one is, in your opinion, who will be leading the update IFRS to push audit reports true and fair? Auditor reports, I don't know that question. I'm not sure if it means auditor reports are true and fair at the moment based on accounting standards. What we need is a push so that they are true and fair based on market values. I don't think, I can't see anyone leading the push at the moment. There has to be some very, very powerful lobby groups to do that. So it will have to come from academia, okay, where there's more and more academic questioning of the IFRS and so on, for there to be some push. Okay, the next one is an anonymous attendee. In COVID-19, I'm looking at the time. I have 3 minutes more. So in the COVID-19 was social distance and work from home rule, do you have any suggestion in which auditors should do in order to audit activities? Okay, so he says, how can you do the audit? Because you have to go to the field and find evidence, and you might not be able to do that with social distancing. That's interesting. I mean, most days auditors hardly ever go anywhere. They don't even go to the stock room to check if the inventory values are correct. They don't actually go and see the stock rooms. So most of the auditors, what they'll do is they will try to look at the accounts and put your forensic accounting software through the numbers, and they come up with their opinion. Okay, I don't think that they are going to actually physically go and look at companies and audit them at this stage. Maybe when the economy opens up, they will. And last one, I think I'll take up. Poona Chand is saying, if IFRS are not used, what will be the mechanism to understand financial statements universally in this age of globalization? Is there any alternate mechanism? Okay, so first of all, I'm not recommending that the financial statements be used universally. That is, I think, the big push that IFRS was saying, that the difference in accounting standards was what caused all the big failures, such as Enron and WorldCom and so on. But actually, there's absolutely no research evidence that it was the fact that different countries had different accounting standards that caused those collapses. Those collapses were caused by unethical directors and incompetent auditors, not that there were different accounting standards. So I don't think I would be pushing at all for international accounting standards of any form. Okay, Chintan, I think that's it. We are coming to the end of the session.
Yes, I think it's nearly 4 o'clock. So thank you very much, everyone. And thank you, Professor Janak, for giving us a very different view of auditors and the auditing profession. In terms of housekeeping, there are a few more webinars lined up over the next couple of weeks. We've got one every week as we all sitting at home and trying to work from home and getting more productive. So if you've got the time, and if you haven't registered already, I would encourage you to go and register on the website. For members, ICMA members, registration is free. For non-members, the registration is a small fee for $35. Thank you very much, everyone, and we hope to see you again next week. Thank you.
Thank you very much, everyone.